Welcome to China in Focus. I'm Tiffany Meyer. In today's special report, we sat down with three guests. Christopher Balding, Senior Fellow at the Henry Jackson Society, Clyde Prestowitz, President of the Economic Strategy Center, and David Goldman, Deputy Editor at Asia Times. They touch on China's 2022 economic outlook, what we learned from the past 2 years, how that's going to impact global markets, and even consumers who might not realize it. Let's dive in. Christopher, welcome. Thank you so much for joining us. Great to have you on the show.
Thank you for having me, Tiffany.
So it seems there's a lot been happening, right? There was the pandemic and the China's zero COVID tolerance policy that's been playing out the past 2 years. And so that's had a huge impact on the economy, not just inside China, but also outside, say, the supply chains and everything. So with that background, how do you see that playing out into this year's economic outlook?
I think it's going to be very interesting, especially with supply chains and international travel. I've just seen today, again, no details at this point, that China is actually releasing a plan for international residents of China to actually avoid the 2-week quarantine. We're seeing problems with supply chains at ports where there's a case of COVID at a specific port, and they shut the port down for a couple weeks or a month or something like that. So it's going to be a major issue going forward. I think everyone that I know of is not really expecting China to open up before 2023 at the earliest with regards to travel and shipping to a more what we would consider normal environment. So how that plays out in supply chains, where we're still seeing significant backups in the ports of Los Angeles, we're seeing significant delays out of China, that's going to be a major issue going forward.
And so going into this year, what are some of maybe the biggest events that you see as playing a role in the economic outlook?
So I think the number one issue for China is, first of all, how they see the economy playing out. With 2022 being what I would effectively call an election year in China, they typically really stimulate the economy in these election years. And I don't think this is going to be an outlier. I think they are going to stimulate the economy. They are also concerned about debt. So I think that's going to be very important to watch. The other one that I would watch is you do have this slow motion train wreck, for lack of a better term, of the real estate market in China, whether it's the developers, whether it's the number of homes that consumers are buying. That is a major issue in China. And right now, there really is no resolution, especially with Evergrande and related type of developers. They're just continuing to kick the can down the road.
And so it seems another big event coming up this year is the Beijing Winter Olympics. And there's a lot of companies kind of caught in the middle. And I think the Eurasia Group even said in their Top Risk 2022 report that a lot of companies are facing kind of a two-way risk, right? So it's on one hand, if they point out the forced labor in China, Chinese companies and consumers are going to kind of boycott them. But if they don't, then they're going to get that in the West. So how, in the face of all of that, how do you see companies being able to play out in this environment?
I think most companies are probably having their PR reps hang by the phone and hope that it doesn't ring, is the best thing that you can say, because it's a situation, as you rightfully pointed out, where if the Chinese side is calling you, it's going to be bad news. And if the U.S. side is calling you, it's going to be bad news. So there really is a no-win situation. At the same time, I don't feel all that bad for the companies, the Western companies in China, because they've very clearly made a choice as to how they're going to behave. Their job is to try and make money, and they're going to do that. But I think their strategy is to try and just avoid saying anything, because no matter what they say, they're going to anger somebody.
And so you actually have experience of living and working in China. So it seems starting a business in China, there's a lot of unwritten rules. So what is it like in that environment?
The Chinese business environment is very unique. And there was, to give you just one example, there was an entire cottage industry. When you filed your incorporation papers to start a business in China, you had to declare, you had to show proof that your company had a bank account with X amount of money in it. But you couldn't open a bank account under a corporate name without the registration papers. So you were in a catch-22. So what would happen was is there was an entire industry of third parties that would basically arrange to have this money for you. Okay, that was what they did. It was a gray legal area for these companies to operate in, but that's how things got done. One of my favorite examples is that Didi, the ride sharing company in China, they were in business for I think about 4 to 5 years, processing millions of rides a day before they got their official business license in Beijing. Okay, this is how it operates. The problem is that it lends itself for business solutions to a lot of very gray market things, even if they're very run-of-the-mill and some less run-of-the-mill issues that need to be solved just managing a business. And so this gives the government enormous authority to control businesses because a business can basically be shown that they've broken the law almost at any time.
And so in that kind of environment, it seems also what we saw happen in Hong Kong, a lot of companies have been pulling out because they feel like they can't operate. So do you see that as transferring into China? It is still, the world's second largest economy, and a lot of companies look at the massive market. But in this kind of environment, do you see more companies pulling out or no?
I think less than necessarily pulling out. What you're seeing, you are absolutely seeing some companies pull out. You are seeing some companies double down. And I think what you're seeing more than anything is a division of supply lines. For instance, companies want to be able to say, if I'm selling to the American market, if I'm a computer company that might be selling computers to the US government, I need to have those computers made in India. I need to have those computers made in Mexico, which is a trusted partner of the US government. And same thing for China. Chinese consumers and Chinese government and Chinese SOEs are saying, I don't trust a product that's going to be made in the United States. I need that product made either in China or some other place. So you're seeing what I would call a bifurcation of supply chains rather than a decoupling.
And so in the world of investing, they say risk is the name of the game, right? But going forward, do you see the Chinese Communist regime as becoming too risky to invest?
I would definitely say it's too risky, and I say that for multiple reasons. Number one, despite this idea that China is a high growth economy, stocks in China over really almost any lengthy period of time have only averaged about 1% to 2% annually. Okay, so if you take any like 5, 10, 20-year block, they've probably only averaged about 1% to 2%. Okay, so you would truly be better taking that money and just sticking it in your bank, a savings account, probably at home, or some similar type of investment. The other thing is that Chinese firms absolutely, whether it's the auditing, whether it's how they use capital, things like that, absolutely do not have the same pressures that companies in the United States have to produce shareholder returns. And return that to shareholders either in dividends or in capital gain. So I think that's another major issue. I think the final issue would be something that I would broadly term national security. A lot of the companies that are listed that U.S. investors are allowed to invest in are actually very closely linked to the government. They're either state-owned enterprises or military-linked companies. And so I think this, just from a national security issue, would also be deeply problematic.
And so heading into 2022, what's the biggest takeaway you want people to have in mind as they look at, say, different markets and China in particular?
I think the biggest one would be we continue to be surprised as to what is coming. 2 years ago, we probably wouldn't have expected where we were now. Even a year ago, I think we probably would be somewhat a little surprised as to the problems that we're now having. So I think that the number one thing, if you're just looking at the economy, is even the best prognosticators is, prepared to be surprised, is the best way to think of it. Because look, if China stays locked down, even until early 2023, that's going to create a lot more issues than we can even think about right now.
Well, Christopher, thank you so much for joining us today. Great to have you on the show.
Thank you for having me.
David, thank you so much for joining us. Great to have you back on the show.
Great pleasure, Tiffany. Thanks for the invitation.
Recently in the U.S., there was the new law banning goods made in Xinjiang. So in light of all of this, do you see the Made in China label disappearing or increasing?
Well, I don't see the kind of investment in U.S. manufacturing that would replace Chinese goods. For example, investment in the U.S. manufacturing sector, defined as the manufacturing subcomponent of the Standard & Poor's 500 index, is down significantly from pre-pandemic. It's down roughly 30–40%. So it doesn't appear that American manufacturers are rushing to put money into replacing Chinese goods at all. And as long as that occurs, if people want electronics, and Tim Cook of Apple Computer says he can't build a smartphone in the United States, Americans will keep buying Chinese products, despite the fact that the sentiment against China is certainly as negative, more negative than it ever has been. But if you want a computer and it's made in China and you can't get a computer made in the United States, you'll buy a Chinese computer.
And now, speaking of those sentiments, one area that's playing out a lot is the upcoming Beijing Winter Olympics. And so the Eurasia Group issued the top risks of 2022, and part of it noted that a lot of companies are kind of facing a two-way risk. On one hand, if they're not pointing out the forced labor and human rights abuses in China, then the Western companies and free markets are going to kind of boycott them and go against them. But if they do point them out, then the Chinese regime and Chinese consumers are going to kind of boycott them. So how do you see kind of companies navigating this kind of field?
I think the Chinese are much better organized. When a social media campaign starts in China against a foreign company, for example, Nike, they hurt immediately. The sentiment in the United States is there, but it's much more diffuse. And you don't see a direct relationship between a political blunder by a company and an immediate drop in their sales. In China, it's heavily organized, it's top-down, it's an authoritarian regime, and they can blow a whistle and persuade people to stop buying. So I would say for the moment, the balance of power is more on the Chinese side, simply because Americans aren't particularly well organized in that respect.
Is there anything Americans do to kind of shift that power balance?
We have a very wide variety of opinion, and although people may express sentiments against China, they may not like what the regime is doing, they may think that China is treating us unfairly in trade, and a majority of Americans certainly feel that way. It's hard to translate that into buying habits. Consumer boycotts as a political weapon have never historically been a particularly effective way of moving the needle in politics. So we haven't been set up to do that in the past, and I'd have to come up blank on what would happen if the federal government were to take a stand on it. Then certainly, if President Biden were to get up and say, stop buying Chinese products in this or that category, or don't buy this product, or ban this product, then certainly would have an effect. But I don't see this administration doing that. I don't think it's likely.
And so in light of kind of all the things happening in China that we've seen in the past 2 years, and as we head into this year, what's your biggest takeaway that you want consumers and companies to look at?
My biggest takeaway is that it's a crying shame that America, which was the dominant manufacturing power when I was young, is now a second-rate manufacturing power. And that translates into a loss of status and loss of political power as well. For example, the Regional Comprehensive Economic Partnership, which is now going into effect, is a trade deal which will basically eliminate 90% of tariffs on a third of the world's economy. China is the center of that. China's imports from the other 14 Asian countries in the RCEP have risen by nearly threefold in the past 5 or 6 years. So the Chinese economy is a source of livelihood for many other countries, even Australia, which is in a very bitter conflict with China over a number of issues, signed on to the RCEP because that's bread and butter. And of course, for many of these Southeast Asian countries, particularly for Southeast Asia, Chinese infrastructure is an important element linking their economies to China. So as long as China maintains its dominant position in world manufacturing, it will have political power. And that position certainly has been enhanced since the pandemic. China's share of world trade and exports to the United States and to Europe have increased substantially from previous levels, and correspondingly, China has more power. So even though the South Koreans, the Vietnamese, the Philippines, the Australians have serious grievances against China, they object to China's bullying and aggressive actions in many respects. Nonetheless, they're still willing to enhance their business and increase their economic ties with China simply because China has the economic power. And unless the United States revives the power of its industry, then I think a lot of our objections to what China is doing will remain ineffective.
Well, David, thank you so much for joining us today. Great to have you back on the show.
Great pleasure to talk to you. Thank you so much.
Well, Clyde, thank you so much for joining us. Great to have you back on the show.
It's my pleasure. Thank you.
A lot of focus now is on China's economic outlook for 2022. So some aspects is the continued pandemic lockdown measures. China does have that zero COVID policy that's been shutting a lot of things down. There's also the real estate crisis, the energy shortage, and just all sorts of things. So what's your take in going into 2022? How do you see this all playing out?
2022 is shaping up to be a lot like 2021. And I think a big question, particularly for China, is really how is the COVID situation going to evolve? Because China has, of course, used this rigid lockdown strategy, which has prevented China from having as much sickness as the rest of the world. But on the other hand, it doesn't prevent new strains, new variants from racing ahead. So I think a big question mark for China is, will it be able to contain Omicron as it has contained the other variants so far?
In light of China's zero COVID policy and constant lockdowns, is China able to remain its world's factory status in light of all that? What's your take on that?
Well, I think, it is the world's factory, and it's very big. It won't change overnight, but interestingly, just before I came on your show, I was having a discussion with some experts in Washington, D.C., who are saying that there's an increasing movement in the U.S. to bring production back to the U.S. or to move it out of China. And I think both for economic reasons and for strategic reasons, we're going to see a continuing movement, or let's say diversification of production away from China.
You also mentioned that in your book, The World Turned Upside Down, how it would be impossible for China and the U.S. to kind of stay connected or coupled economically. So do you see any changes going forward in 2022 in that view?
What I see is a continuing pressure in the direction of decoupling. And if you think about it in a couple of different ways, one pressure is purely supply chain. The global supply chain has shown weaknesses over the past 2 years. So corporations and governments are taking steps to reduce that weakness and to diversify the supply chain. But on top of that, I think there's an increasing disconnect between the values and the expected behavior of companies and leaders who are engaged with China and also with the outside world. So, for example, in response to the genocide in Xinjiang being carried out by Beijing, the United States government has ordered U.S. importers not to import anything made in Xinjiang. So companies like Walmart, for example, have had to shift what they were importing from Xinjiang. They've had to shift it to import it from somewhere else. Now it turns out that the Chinese government is punishing Walmart for shifting its sourcing of production away from Xinjiang. I think more and more free world executives and major corporations are going to be faced increasingly with this contradiction between wanting to do business in China, but in order to do business in China, they have to betray their own values. And I think that increasingly they're not going to betray their own values. They will be forced either by their own personal values or by their governments to diversify away from China.
In light of all of these different aspects, what can maybe consumers here in, say, free countries or companies do to kind of stem those risks?
Well, consumers can't do very much. Of course, what they can do is to make an effort to buy things that come from places other than China, but that's difficult to do in many markets because almost all of the products are made in China. So consumers' role, I think, is limited. But corporations, corporate leaders can do a lot. And in my view, they should be very actively looking at ways to diversify their supply and their production away from China. And part of that would be to bring the production back to the United States or to Mexico or to other third-party locations. And I think there's one other element here that has not been discussed very much, but which I think is quite important, and that is greenhouse gas emissions. So over the last 20 years, we have created this global, very extended global supply chain. And that means that the goods and the components are moving across oceans. And in fact, in one case, I looked at the semiconductor industry, and I found that to produce a single semiconductor, one of the parts involved crossed the Pacific Ocean 10 times before it got to the final consumer. Now, 10 times by air across the Pacific Ocean creates a lot of carbon emissions. The cost of those carbon emissions is not counted. It's never included in the final cost of the product. If we're really serious about reducing carbon emissions, and we must be serious about reducing them, we need to begin taxing carbon. So if we put a carbon charge on every one of those flights across the Pacific, that would dramatically change the production economics and would be a big push toward diversifying the global supply chain and let's say shortening the global supply chain.
What would you think is the biggest thing people should focus on to gauge kind of China's economic outlook for this year?
Well, I think two things. One is what's happening with COVID. That's very important. And secondly, because the Communist Party under Xi Jinping has really been tightening its control, not just of the politics, but of the economy and the production. And it has been increasing the role of state-owned corporations and reducing really the role of private entrepreneurs and private industry. So I think it's important to watch how that evolves in China, because on the current path, I think we have to expect that China's growth is going to be reduced. And in fact, the Chinese Communist Party itself is predicting that the growth rate will be lower than it has been in the past. So I think that's what we need to watch.
Well, Clyde, thank you so much for joining us today. Great to have you on the show.
It's been my pleasure. Thank you, Tiffany.
And for those just tuning in, that was today's special report with Christopher Balding, Clyde Prestowitz, and David Goldman. Thanks for watching, and see you next time.